So, hello, officially. Thank you for joining us for our annual ACA Reporting webinar. I'm Kristen White, Human Resources Compliance Consultant here at Morrison Garritano. I'm on the Employee Benefits team, here to help you with all your compliance needs. We'd like to start each year with ACA Reporting. We do have a new distribution option that was introduced last year. However, all of the requirements of reporting are the same. The data required, the IRS forms, the deadlines are all basically unchanged. So for our experienced ACA folks, this webinar will just act as a reminder. For those new to ACA reporting, we know it can feel overwhelming. You're not alone. We've all been there. Take the time to review this webinar, both the slides and the recording. If you run into questions, I'm here to help. For all of you that registered, we will send out an email with the recording and the slide deck. Give us a couple days on that, hopefully by tomorrow. But if you don't get it, some of the emails go to spam. It will be posted on our website, and I'll show you that at the end here. During this webinar, you can submit general questions. Use the Q&A feature. However, for company-specific questions, it's best to reach out to us separately after the webinar. Here's our little agenda. So we'll quickly touch on the first few items, then spend most of our time on the how to file. I think of ACA reporting as the employee benefits version of W-2 tax forms. So we all know W-2s are a summary of the payrolls that are processed throughout the year. Similarly, ACA is a summary of medical benefits for the year. So if your system is set up correctly and you maintain clean data throughout the year, then ACA reporting should go quickly. So I mentioned that because I don't want you to feel overwhelmed with this annual task. Who is required to file? So this is an important piece here. There are two main factors: medical plan setup and your company size. So we'll start up here, self-funded. So if you had a medical plan that's self-funded, then you have a filing requirement. So this includes partially self-funded, such as level funded, some call it balance funded. However, most of you have medical plans that are all fully insured, so you don't fall into this first bucket. However, down here, if your company has enough employees to be considered an applicable large employer, they use acronym ALE, that's defined as averaging at least 50 full-time equivalent employees in the previous calendar year. That's a mouthful. Now, we're going to touch on this more, but this term full-time equivalent, for ALE calculation, that's based on your employees that average 120 hours in the month. And again, we'll touch on that more, but that's a number you want to keep in mind. Because some of your systems, like if you're using a payroll system, they might think that a full-time equivalent is 40 hours. But for ACA, it's 30. And then to make it more complicated, if it's ALE, it's like 120 hours in the month. So just 30 hours times 4 weeks. For the ALE formula, for all employees need to be included. So part-time, full-time, even if you have union people, prevailing wage workers, all of that. Anyone you consider an employee needs to be counted when you're trying to determine if you're an ALE. Plus, companies and any related companies, employees in related companies. So for more information, we have a lot on our Morrison Garritano ACA page to help you with this ALE determination. And I'll touch on a little more here too. But if you don't fall into either of these two buckets, then you do not have ACA reporting requirements. You're welcome to stay on, but really these are the two buckets that we have. What forms to file? Okay, so this is one of my favorite slides. You might have all received, several of you received emails from me with a screenshot of this one. We also have at the top of our ACA page. So this is one I refer back to often. The big takeaway here, because there's a lot on the slide, is just really knowing which bucket you fall into and which forms you have to do. So the two buckets I mentioned determine your reporting requirements. I talked about self-funded and I talked about ALE. And for ACA, they call them two different series of forms. They call it B series and C series. So you might hear some of those terms. So on this table, we're going to start at the bottom row. insurance carriers are required to do B series reporting for all fully insured plans. That means if you're a small employer, I'll go in here, with only fully insured plans, so you're not an ALE, then the carrier handles all the reporting. However, if you are an ALE, that means 2 sets of reporting is required, one from you and then one from the carrier. Next, we'll touch on this right-hand column for self-funded. So depending if you're also an ALE, you're in this first row, or if you're not an ALE. So that determines which forms you have to do. But if you have a self-funded plan, then there is a reporting requirement because your carrier does not do any forms. So lastly, we're laser pointer here. With the top left box, ALE fully insured. This is where most of you fall. You're required to do C series forms. However, the last section on the employee form should be left blank. It's a covered individual section, which is reported by your medical carrier. So that means the employees that were actually enrolled in coverage will receive 2 forms. Okay, so really what you need to know here is which bucket you fall into so you know what your requirement is. When to file. I'm going to keep circling this March 2nd one. This is the date I want you to keep in mind. So that's the deadline to distribute forms to individuals. Employees that are considered an ALE and then ACA full-time during the year. So any of your full-time folks need to get a form. Now, if your plans are self-funded, then those forms are also needed for all covered individuals. But again, if you're fully insured, you just focus on your full-time. Now, March 31st is a deadline to file electronically with IRS. However, let's stick with that March 2nd. Keep that one in mind. So I encourage you to start now, start in January, to at least review your data to determine what work is needed, if any cleanup is needed. Have the goal to complete both steps by mid-February. First, check with the vendor that you do your reporting through. Some vendors have their own deadlines as early as January. And then some vendors also charge higher fees when you file near those deadlines. That's why I'm suggesting filing a couple weeks before that March 2nd deadline. And then most companies do both the distribution and the filing at the same time. So again, that's why I'm harping on that March 2nd deadline. Some states have their own requirements. I'm going to touch on this, but really the takeaway, if you're fully insured, you can ignore this slide. But so originally, the federal government created what they call an individual mandate, which means all citizens are responsible to have medical coverage. Individual meaning employee, citizen, so not necessarily the company. But then the federal government reduced the mandate down to 0. So technically it's still there, but there's no penalty for it. That sparked a handful of states to create their own individual mandate, which is why reporting is required at the state level. And California is one of those. So in California, we technically have a deadline to provide forms to individuals by January 31st. That was the original IRS deadline, and California just never pushed it out. However, California does not impose a penalty for missing that deadline. So as long as we're on the March 2nd, then we're good. But as I mentioned, important takeaway on this slide is that only those with a self-funded medical plan need to file with the state. For fully insured plans, the carriers handle that requirement. Why we file? Of course, we file because we want to be perfectly compliant, but mainly we file to avoid all those penalties. So there are 2 types of requirements, each with their own penalty. First, you need to offer the appropriate coverage, and 2, you have to do the reporting. Sounds simple enough. I mentioned individual mandate, meaning employee. There is also an employer mandate, which is really what we're here for today. So if your company is an ALE, then you're required to offer medical coverage to your full-time employees and their dependent children. The coverage needs to be affordable, provide minimum essential coverage, and meet minimum value. So those are a lot of terms there. Really, the piece is making sure you're offering it to your full-time people and it's affordable, the rates, which we'll jump into both of those. I mentioned the 30 hours. So that's here, the average 30 hours. There's a couple different ways they calculate that. I mentioned I threw out 120 for ALE, so that can get a little confusing. So both of these consider full-time at 30 hours per week. So if you average that, then a person's considered full-time. However, for ALE versus actual full-time employee, the calculation is slightly different. So again, both use 30 hours, but determine who is an ALE to see if that counts if you get to that 50 average. That's based on 120 hours in the month, like I mentioned, so just 30 times 4. However, once you determine you're an ALE, that's kind of like a one-time thing. If you're on the border, you might have to check each year. But then throughout the year, to determine which employees are full-time, that 30 average, the formula comes out to 130 hours per month. So that's probably what most of you are used to. So during the year, if an employee has at least 130 hours, then they're considered full-time and need to be offered coverage. Okay. For the first time, the penalty amounts went down slightly for the 2025 calendar year, but of course, they're going to go up again for 26. I mentioned the employer mandate. So the code there, they call it 4980H, the letters and numbers that they're out. And there are two versions. Both of these are triggered if your employees enroll in coverage in the marketplace, such as Covered California, and they receive a tax credit. So penalty A, if you offer minimum essential coverage to your full-time employees, so that's a requirement for penalty A. So if you did not, and if any one of those employees receives a subsidized coverage, then the penalty applies to all your employees. So let's break that down. So if you provide the right coverage, so if you miss at least 95% of your population, and if any one of your employee has a subsidized coverage in the marketplace, then you have this penalty. This is per month for all your full-time employees, not just that one that went to the marketplace. But most of you should pass this one. I'm not as concerned there. Where we might have something is down here in the second one. So penalty B, the coverage you offer must meet minimum value, which our plans would, and be affordable. The dollar amount of this penalty is technically higher. You can see the 300 versus the 200, but it's only applied per employee. So if an employee receives subsidized coverage, then the penalty would apply. But it's only if they waived your coverage. So if they chose to enroll in your coverage and somehow they also got coverage in the marketplace, then that wouldn't count. So we're just talking about somebody who waived your coverage, enrolled in the marketplace, like Covered California, and got a tax subsidy from them. Then you would be charged this penalty for not offering affordable coverage. And we do have more information on our ACA page to talk about all these different affordability options. So we'll talk more about that. The other type of penalty I mentioned is for just not doing the reporting. So technically, on this slide, there's two separate penalties for missing the 2 March deadlines. However, the IRS usually charges both. They assume if you didn't file with them, you probably didn't give forms to your employees. So essentially expect a letter from the IRS, the penalty of $680 per individual form. So for example, if you're meant to file 100 forms, that's $68,000 in penalties. Separately, California has a penalty if you miss filing. However, as mentioned, if your plans are fully insured, then your carriers will handle it. Now, I only briefly touch on the penalties because I assume everybody here is planning to do ACA reporting, so hopefully you don't have to deal with any of these, but it just shows you the importance of getting this reporting done. How to distribute the forms. Some of you may recall at the end of December 24, a federal bill was signed into law in an effort to make reporting easier. The biggest change is that the forms to individuals can now be distributed upon request. So I mentioned all the regulations the same. This is the one thing that is slightly different, but again, it's just optional. Still, our most common distribution method is for companies to mail hard copy forms. That's still what we see most people doing. Electronic distribution is an option. However, you need to ensure you first have consent from each employee, similar to W-2 distribution, since it can be administratively burdensome to obtain and track consent and then be consistent. So most choose still just to mail all the forms, but no, this is an option. Lastly, our new one here, upon request. So to do that, you would have to satisfy all of the steps here we have listed out. And really what they're wanting to do with these requirements is to basically make sure everybody knows. So that's your current employees and any former employees, anybody who worked during the year, that they know that they can request the form from you and how they do that. You would have to have this posted by the distribution deadline of March 2nd, and then provide any forms within 30 days of the request. If you're currently printing and mailing, this could certainly save some money up front. However, consider the administrative work of responding to individual requests. You could see employees asking where the form is. You have to explain that. So again, that's based on your culture and if you think your employees would ask for this, because they're not required to use with their taxes. Some people think they are. If they use a tax advisor, they may ask for it. But really the information that they're required on their taxes is to attest that they did have coverage all year, back to that individual mandate. And the form that would show that would be from the carrier, again, if you're fully insured. Okay. We've covered the who, what, when, why, and some of the how with ACA reporting. We'll spend the rest of our time on our last agenda item, how to file, how to complete the forms. There are two types of forms, individual and summary. 1094, it's a summary report. We'll cover it first because it's a great place to start to check for errors. (1094) is considered the cover page to the individual 1095 forms. Listed here are all the data items. I won't go through them because really they should be in your system. They should all pull from your database and then go into your forms, as long as you're set up correctly. So you shouldn't have to manually enter any of this. 1094C form has 4 parts. The fields you need to populate, I have highlighted here. So this is something usually set up once in your system, then it should populate each year, again, similar to W-2s. So the top here, you have basic employee information, including your company name, your tax ID, your address. So all of that you need to make sure matches your W-2s. Down here, number 19, they have this term authoritative transmittal. So everybody I know marks that as yes. The only reason why that would not be checked is if for some reason you have different areas of company where you want to file your 1095 separately for each area, which is certainly not common. Part 2. The first one here, 20, this is just the count of the forms, which really should be the same as what it was in part 1, and that should be from your system. 21, 22, this would be something you would do in setup and then should automatically populate here. And we'll touch on these 3 circled areas in our next few slides. But 21 is asking if your company is part of an aggregate ALE group. It's a new term we're throwing out there. Really, it's based on if you're in a controlled group. Then line 22 has these 2 options. You can mark both, just one, or leave them blank. No concern with leaving them blank, but if you do qualify to select one or both, then it can simplify your reporting. Line 21, so this is where you mark yes if your company is part of an aggregated ALE group. So what does that mean? So that means your company is under common ownership in a controlled group, affiliated service group, and then combined, you met that 50 FTE threshold to be an ALE. So if you are part of an aggregate ALE group, then you have ACA responsibilities, even if your company, your entity, has fewer than 50 FTE. So each entity in the ALE group, based on each EIN, needs to file separately, just like you would W-2s. However, in your reporting, there is a place where you do need to list the other entities, and we'll show that. And again, we have more information on our ACA page. You may also want to check with your accounting team or tax advisor on your controlled group status. Qualifying offer of coverage method, another big term for us. So if you do meet this offer of coverage, and it greatly simplifies reporting, there are 2 fields on each employee's form you can leave blank. And those are the 2 fields that people find the most complex. You must have made a qualified offer of coverage, meaning your medical plans have minimum essential coverage and minimum value, and that was offered to all your full-time employees. Plus, you offered coverage to their spouse and children, which most of you already do all of those things. But the third one there, the coverage must also meet the federal poverty limit safe harbor. We'll touch on this more later, but for 2025 calendar year plans, that means you offered employees medical coverage where the cost for them to cover themselves was only $113 a monthly or less, which that can be challenging to meet. But if you do, then go ahead and check that box. Our last one here, our 98% offer method. So ALE companies are already required to offer affordable coverage to at least 95% of your full-time population. Most of you offer coverage to 100% of your full-time population. So if you know that you have your employees classified correctly for full-time versus part-time, and you offered coverage to all of those that qualify as full-time, then go ahead and mark that box. It allows you to skip the section where you need to list all your full-time employees. Okay, part 3. So this is where I really want to focus. So column A, minimum essential coverage. See it up here. This is the primary driver of ACA penalties, normally due to inaccurate reporting. So verify column A is marked yes, either in the all 12 months row, we have here, or in the 12 monthly rows. This indicates that you offered minimum essential coverage to your full-time employees and their dependent children. B, full-time employee count. Reminder, the ACA definition is employees with 30 plus weekly hours or average 130 hours monthly. In the previous slide, we covered the 98% offer method. If you checked yes there, then this column B can be left blank. C is just your total employee count per month, which should automatically pull from your system. D, mark if you were part of an aggregate ALE group, as discussed earlier. Most of you will leave column D blank. So when you're reviewing reporting, the first thing I do is recommend people to come here. So we're on the 1094C part 3, column A. So when you're reviewing that, let's start here. So in column A, if it does not have a yes marked in all 12 months, that's a big red flag telling you to check your data. If not corrected, expect a penalty from the IRS if any full-time employee received a penalty tax credit towards individual marketplace coverage. The last section of this company level form is only for those that are part of an aggregate ALE group. So each company does their own reporting based on your EIN, just like your W-2s, but you need to list all the companies in the group that had any other full-time employees. We made it through the first form. Now on to 1095C form, which is where we'll spend the rest of our time. The 1095 forms are for each individual, meaning your full-time employees, both current and former. So ALEs must provide a 1095C form to any employee who is employed full-time during any month in the calendar year. A 1095C must also be provided to any individual, including non-employees, who participate in a self-funded group medical plan during the year. For employees who are part-time all year, not covered under a self-funded plan, you do not need to give them a form. I know some of you offer coverage to part-time, but they are not required to have these ACA forms. Most of you will only populate the first two sections on here, which includes your basic data, then information on the medical coverage you offered. Part 3 is only populated for our self-funded plans. As I mentioned, these forms are a summary of medical benefits for the calendar year. So if your system was set up correctly and you maintain clean data, then all the fields should automatically populate correctly. Part 1 is where you populate the employee and company basic data. So you can see things, again, like your W-2, the employee name, their social security number, their address. So things you want to make sure that you have completed for everybody of accurate, which most of you already would, especially just doing benefits throughout the year and providing W-2s. When reviewing your reporting, this is where the majority of your time will be spent. So we'll dig into these. So we're on 1095C Part 2. The plan start month, this is based on your group coverage, not individual employees. So this will be the same probably for all your employees. Now we have lines 14, 15, 16. So this needs to be true for the whole month. Like if you mark something in January, then you're saying that that was accurate for that full month. So you have 3 different rows here. Line 14, this row needs to be populated on all the forms. Line 15 should reflect the lowest cost single value minimum coverage offered to each employee. Now that can be challenging to, that concept is challenging to remember, so I'm going to touch on that a little more. We'll keep that there. Line 16, affordability safe harbor, provides additional information such as not employed, part-time, enrolled, waiting period, affordability safe harbor, etc. (1095C) Part 3 is only for companies that have a self-funded plan, including partially self-funded, such as level funded. If you only offer fully insured medical plans, you can leave this section blank. Your medical carrier will report this on the B series forms. So most of you can skip this section. We're going to spend the rest of our time on coding the 1095 forms. These are your tool to report on the medical coverage you offered during the year. And that's the information they use to confirm that you met the employer mandate or to know if you need to be assessed a penalty. We say these forms tell a story. I already mentioned the 3 lines there. We'll keep touching on that because that's an important piece to remember. But line 14, did you offer medical coverage that month? Line 15, the lowest cost plan offered. How much will the employee have to pay just to cover themselves? And 16, if you did offer coverage, did the employee enroll or was their premium affordable? If you didn't offer coverage, then why not? All right, so this is my favorite slide, not just because we have pretty colors, but this is something that I reference often. There's a lot of codes on here, and that's what you're meant to populate on the forms. No one expects you to memorize all these codes, so have this handy to refer back to. We do have a standalone copy of this chart linked on our ACA page, which I'll show you. So I recommend having it up and ready to go when you're reviewing your forms. All right, so we start with line 14. We're telling our story here. So we said line 14 is offer of coverage. So in our left-hand column, select the appropriate code, and then based on that, which code in the right-hand column coordinates with that. Let's get into it. So for example, if you didn't offer coverage, then use the blue codes. 1H, no offer. Plus pick the list on the right. So no offer of coverage, and then why not? They were not employed, they were not full-time, in a waiting period. So you have options there. If you did offer coverage, then most of you will either use 1A or 1E. So 1A meaning the qualifying offer of coverage, including federal poverty limit and safe harbor, so you don't need a line 16 code. Most of you will use the 1E, and then you can use the appropriate green code. So either they enrolled, or if they waived, then that's where you're talking about your affordability. Here are the most common code combinations, similar information to the previous slide, just shown in a different format. Affordability safe harbor. So we'll spend a little bit of time here, but again, more information on our website. So you need to determine which safe harbor code is appropriate. And then that's what you're going to put in that line 16. So this is based on the lowest cost plan offered to each employee and how much the employee would have to pay just to cover themselves. It doesn't matter if the employee elected a more expensive plan or added their dependents. So for these forms, the IRS is also not interested in how much the company had to pay. They care about the lowest premium offered to the employee. This is something you would first set when you're doing your rates for your plan year, just to make sure they're affordable. But then once the calendar year is complete, then run the numbers for the year to select which of these safe harbors makes the most sense for reporting. You can use that code. The IRS sets the rates for the calendar year. So you need to use the rate based on the year in which your plan starts. So kind of note that down here. So for example, if your plan starts in July, then for this round of reporting, the first half of the year, we based on 2024 rates. And then note that that same safe harbor should be used for all employees in a class. Okay, now on to the 3 safe harbors. So we have 3 here, given options. And so we recommend just starting with the first one. If you can meet the first one, then you stop there. If not, then you move on to the next one. So federal poverty level is the simplest calculation because it doesn't even look at your employees' pay. But again, that would only work if your premiums are low enough to meet that. Next, rate of pay. That's our most common. However, it only includes base pay. It's like your base hourly rate or your monthly rates for your salaried folks. Now, if you can't meet that, then we do have some groups that use that W-2 safe harbor. It can be more generous, but it's a little bit of a gamble because you'd have to wait until January, so the whole year is complete to confirm that you met affordability. So it's often used for those jobs that maybe only pay commission. Again, we know it's going to be complex, so we have more information on our ACA page. Okay, we'll spend the rest of our time reviewing the 1095-C forms with practice problems and auditing forms that may have errors. We have several slides of examples. This can be a lot to absorb in a webinar. So in addition to following along now, I think it'd be even more useful for you to reference back the slide deck when you actually audit your forms. We have an example company here we're using. So they've met all of the offer requirements. They have a 2-month waiting period, and their lowest pay rate is California minimum wage. So they meet the rate of pay safe harbor. These codes are the most common example. So you see on the slide here, we have a snippet of that section of the form. And then down here, we have a smaller version of that code chart. It's going to be a little small to read here, but just know that you have all of that and kind of look at the colors. So what this is telling us is that they offered coverage for the entire year. So we're using this all 12 months column. Again, you can still put in every month if that's easier. Every system does it differently. But this saying that we offered coverage for the entire year. 175 is the lowest premium they offered to cover themselves. And then 2C means the person enrolled all year. As I mentioned earlier, this doesn't mean the employee actually enrolled in this plan that was $175. They could have enrolled in a more expensive plan or add dependents. So that information is not included in the reporting. On this one, this company has a qualifying offer of coverage, meaning they met that federal poverty level safe harbor. That means they can use the code 1A and then leave 15 and 16 blank. Now, some people, even though they met that and they can leave 16 blank, they choose to populate it, so it's optional. If you do populate line 16, it would either be 2C, that you offered coverage, or 2G, that they waived and you had the federal poverty limit safe harbor. Similar to the first example, this employee was offered coverage all year, the rate of pay safe harbor, however, they didn't enroll until July. So if the month's not enrolled, the safe harbor code needs to be populated in line 16. Here we have a new hire. During the first half of the year, they were not offered coverage because they were not employed. Once hired, they were in a waiting period for a couple months. Then starting in July, they were offered coverage and they enrolled. Similar to the previous one, new hire was offered coverage starting in July, but they chose to waive. This one builds upon further our new hire that enrolled in July, but then they terminated in September. Similar to the new hire, this employee was not eligible until July. However, they were already employed, but they started the year as part-time, which is why for Q1, they're coded as to be not full-time. Similar to our first example, this employee was enrolled all year. So we have our 1E and 2C codes. However, the premium offered changed mid-year, like at their open enrollment time, with their plan starting in July. Normally, you wouldn't have a form for an employee that wasn't offered coverage. However, here's a rare example where it is appropriate to use this code 1H all year. Here we have a union employee. So that's what our 2E is here. So again, we're looking at the blue. So 1H, no offer of coverage. And then we have the union over here. So in line 16, where you indicate why you didn't offer coverage, you would use code 2E, meaning they were offered coverage through a union and you made a contribution on their behalf. Now we get into the errors. So you see the red on the screen. So these are here to help you spot issues that need to be corrected. Often your system will catch a lot of these and then have them flagged, but you'll want to be able to recognize them yourself. So a common error is when a non-full-time employee or employees who are never eligible for benefits have a form processed. So if not eligible all year, do not send a form. This one has the wrong code in line 14. Since the premium does not meet that federal poverty limit safe harbor, they can't use code 1A. So they need to use that 1E code. Since the data in these forms is a summary of what happened during the year, clear records, they're not maintained, that can cause the errors in the forms. So in Q3, we showed 1H not offered covered paired with 2C enrolled, which doesn't make sense. That usually means the system, for some reason, didn't capture that original offer of coverage. In Q4, it shows 1E offered coverage, but then 2A not employed. So again, that wouldn't make sense. So that could be caused by maybe a termination date that was entered late. Last one. Most of the errors in these forms can be spotted just by looking at the form due to the wrong code combination. So here, December is the only month with acceptable code combination. So again, it goes back to our fancy colorful chart. So it's not only if each code makes sense, but you have to make sure that they make sense when you're telling your story. So key takeaways, the IRS does impose penalties. So it may take them a couple years, but if you don't offer the appropriate affordable coverage to your full-time employees and you don't complete the reporting timely, you certainly can expect a penalty letter. So provide accurate data by the deadlines, ensure the codes in the forms are correct, audit, audit, audit. Most of you use your payroll vendor to file and they create the forms for you, which is wonderful, but ultimately you are responsible. So be sure to know your vendor's deadlines and allow yourself enough time to audit. It's much easier to make corrections before filing than a couple years later when you get an IRS penalty letter. Lastly, retain copies of everything you file, plus your source data in case you're questioned later. think every penalty letter that a client has shared with us, it's because there was an error with the reporting. So just keep all of your documentation. That's a lot of information. I do recommend that you revisit the slide deck and recording as a reference when you prepare and audit your reporting. We do have on here the IRS and California ACA links. I'm going to spend a moment to jump into, we have this new ACA readiness page on our Morrison Garritano website. We have more information on ALE determination, affordability safe harbor, and ACA reporting. All right, so now we're here on our website. I mentioned one of my favorite slides was showing which form you need to do. So we have a snippet of that here on the top. And then we have 3 main buckets here. We start with ALE determination and then the affordability safe harbor. With both of these, we start with a little video where I'm just introducing you to the topic, and then we dive in deeper to more detailed information. Like this ALE even has a calculator. Mineral, which most of you are in. If you're not, we can get you access to Mineral. It's a free HR benefits platform we offer to all of our clients. They have a toolkit, I think, with 60 different links, which can certainly be overwhelming. So we put in a few detailed links here to get you to the right place for this topic. Some are on affordability, and they have their own calculator. And then bottom here is our reporting. So we have links to the actual IRS forms if you want to jump out there, and they have their own instructions. That cheat sheet that I mentioned, a great one to look at. And then again, in the Mineral Toolkit, they have a great guide on reporting. Down here, we have the links to register. You're already here. So this will be replaced with links to a copy of the recording and the slide deck. So again, if you don't get our email the next couple days, maybe went to your spam, you can just come back out here. Okay. Let's close that. So we made it to the end. For all of those that registered, again, we'll send you the recording of the slide deck. Like I said, we posted on there, it gives me days. So for now, you can submit questions in the Q&A feature if you haven't already. However, if you have company-specific questions, we do recommend that you contact us directly. We have an email account set up for anything compliance, including all these ACA questions. So it's just compliance@morrisgarritano.com. And on that ACA page at the bottom under the reporting, there are frequently asked questions section. So if you feel like we didn't get to your question today, then I do recommend that you check there, and then you can certainly then email us. All right, so we have Sarah in the background here. Do we have any questions today?
So far, we just have one because I think you were so thorough in what you went over.
Goodness.
And really, it's just a clarifying question from slide 24, referring to Form 1095C. Just clarifying that the plan start month refers to the month of annual renewal. Is that correct?
Right. So if your plan year starts in July, then you would just put 07. So a lot of you are calendar year, you start in January, you would just put 01. So again, that'll be the same really for all your employees.
Great. All right, we got another one in here. How do I know if an employee gets subsidized coverage?
Yeah, you don't, unfortunately. They say that they're going to send companies information on that if somebody applies for that coverage, but I haven't seen that in practice. You can certainly ask your employees where they're getting their coverage from, but that's not something that most companies know. So ideally, you're offering the affordable coverage to all your full-time employees.
All right. That's it, unless anybody has some last-minute burning questions on ACA.
Wonderful. Okay. Well, again, thank you all for joining today. We'll give you a few minutes back in your day. We know this is complex, so you have this here as a reference if you want to watch the whole thing again, or if you want to just jump back into the section we have questions on. We have our ACA readiness page. Mineral has tons of resources. And then certainly you can contact us with any questions. So thanks for joining. Have a great day.